Thanks for joining us for this Quill Group Investment Committee update. My name's Mark Beveridge. Just going to take you through very quickly the events of last year, which was a pretty stellar year when we look back at it. The equity and property markets were up almost 30% in some cases, certainly 20% for the Australian listed property and global listed property. So it was a good year in spite of some geopolitical turmoil and, as we say, pretty poor fundamentals there, where S&P 500 profit growth only grew 3.6%, and yet the shares were up 28.9%. But of course, what everyone wants to know is what's happening for the year ahead. Well, we make the bold point there that past performance is no guarantee of future returns, and we want to focus on not trying to forecast what might happen, because realistically nobody knows exactly what will happen. But it's better for us to just acknowledge the current conditions and talk about what could be ahead, and why discipline and diversification in the portfolio is so important. It could well be that this so-called coronavirus might develop beyond expectations and tip over some already weak economic conditions into recession. But in spite of that, we have a look back at historical markets and how they've played out over a number of decades. We have three slides here. The first one starts in 1992 and goes through to year 2000. And of course, the year 2000 was the glory days of the tech bubble, and US stocks beat Australian stocks by a very, very wide margin over that decade. In fact, I recall a few large public service super funds pouring their money into international stocks, and the US in particular, because they said at the time that Australia was just so last century. Well, that all changed in the following 12 months. If we look at the decade from 2000 to 2010, the S&P 500 was still 38% behind where it started 10 years prior to that. And yet the ASX 200 was up 134% total over that period. So how things can change, and that's why we're saying here, past performance is not necessarily indicative of the future. Fast forward to the next 10 years, from 2010 to 2020, again, we can see that there's been a massive outperformance by US stocks, but valuations in the US, particularly amongst the US market darlings, is reaching a bit of a fever pitch. So it seems like there's a bit of a pattern developing here, but we also acknowledge that if it's obvious, it's obviously wrong. So we don't just simply switch from one winner to last year's loser, but we keep rebalancing and diversifying the portfolio. So we appreciate your loyalty to us. We're certainly here to help you sleep easy at night and to have well-constructed and well-diversified portfolios to look after your money.